Recently, an economist came out and made a very bold proclamation that just about every bank was insolvent. I had to think to myself, could this actually be true? Are we in real trouble of losing our banking? So I hunkered down here in the bunker and dug up an interview that happened with Yahoo Finance. And lo and behold, there's actually a lot of factuality to this. So let's get into this. In an interview with Yahoo Finance's with Rachel Akufo, Columbia Business School professor of real estate Tomas Pikorski said that in a scenario where 50% of depositors are uninsured, you have about 190 banks in a precarious position, meaning the remaining value of assets is not enough to cover the face value of the insured deposit obligation, meaning the money that you have in your bank account right now. Now, of course, these bank runs can become more pronounced. Pikorski adds that in a scenario where 100% of depositors are uninsured, almost more than 1,600 banks are deemed potentially insolvent. Yes, that is a massive number. The Federal Deposit Insurance Corporation said shortly before Silicon Valley banks collapsed last year that the market value of U.S. banks' long-term assets had dropped $620 billion in 2022. New research co-authored by the Columbia business professor finds that the banking industry's unrealized losses are now more than 3 times that. Guys, let that sink in. The system's actually accumulating $2.2 trillion in unrealized losses in just the past year. Meanwhile, there are definitely people taking notice of this, mostly the central banks, which you've heard me talk about many times over on this channel, and moving their money to gold, which has been on a massive run of late because people flock to gold when they are worried about the economy and things like bank failures, geopolitical turmoil, and the such. We have an election coming up too, so I get my money out of the market. Now, we may seem like doomsday preppers on this channel, but that's not our MO here at Tech Economy. We're just guys with our eyes on the prize, and we like to talk about what is going on because the real information is hard to find. Trust me, I wish we could come here every single day and make videos about the stock market and how the economy is booming and paint a rosy picture and that the banks are as safe as ever and your money is good, but that's simply not the case right now as I'm making this video. Now let's get back to the banks. The paper losses across the U.S. banking sector suggest that other banks with high levels of uninsured depositors, keyword they're uninsured depositors, and large losses are also prone to solvency crisis that could trigger bank runs. Remember what happened last year? Yeah, a few banks went down and it was chaos. So if you were banking there in those banks that went down, it was hell to get your money back. So in this interview, we learned that in a scenario where 50% of depositors are uninsured, there's 190 banks that are in serious trouble should there be a bank run. Now, even worse, in situations where 100% of the depositors are uninsured, there's almost 1,600 banks that are deemed insolvent. Now, to put this in perspective, there were 4,049 commercial banks and 565 savings and loan associations in the United States. Now, these are insured by the Federal Deposit Insurance Corporation, so anything that's outside of that, I'm not counting. This is as of October last year. There could be more, there could be less. That's the most recent data that my research team could dig up, so kudos to them for grabbing that information. So over 40% of the banks in the USA are in serious trouble and actually fail. In 2023, we had 5 banks fail. This year, this number could go much higher. So what am I saying here should not be a surprise to you. Diversify. And you know that Greg and I have money in gold and silver, but I'm not going down that path today. And if you want to go down that path and join us, there's a link below, but I'm not harping on that. That's not what this video is about. I'm just here to tell you 6 ways that you can protect yourself and come out okay, no matter which bank you use. So let's get into that right now. How to protect yourself. Number 1, know the FDIC. Very important. The FDIC insures traditional deposit products such as checking, savings, and money market deposit accounts. Not money market mutual funds to be actual exact, and certificates of deposit, as well as cashier's checks, money orders, and other items that are issued by that bank. These deposits are insured for up to $250,000 per depositor, per FDIC insured bank, per account ownership category. Okay, very key points there. The FDIC insurance limit has been the same for more than a decade. It should go up because of inflation, if you ask me. The FDIC does not insure investment products such as stocks, bonds, mutual funds, annuities, and life insurance policies, so know that as well. Nor does it cover the contents of safe deposit boxes. Number 2, use bank networks to maximize coverage if you want to spread your money around to expand your FDIC coverage. Now, there are bank networks that can do it for you. IntraFi Network Deposits will put your excess deposits in checking accounts, money market accounts, and CDs at separately chartered FDIC banks in its network. Pretty cool. Using a bank network to protect excess deposits is convenient. You also receive account summaries out of Form 1099 for your taxes. Makes it real easy for you at the end of the year. Third tip to keep your money safe. Open accounts with different ownership categories. So let's say you have, for example, $300,000 in checking, savings, and money market accounts in your name alone at your local bank, wherever you live. Dubuque, Iowa, Miami, Florida, New York City, who cares? This is because the bank FDIC limit is $250,000. $50,000 of your money is not insured because you're the only depositor. So one way to fix this is to ensure that all of your money is to open accounts with different ownership categories. For example, you could open a joint account savings with a spouse, or almost anyone for that matter that you want to sign up with. Be careful about that though, you get on board with, and be eligible up to $500,000 of FDIC insurance, because each account holder is insured for up to $250,000. Now you could set up a trust and name beneficiaries who would receive the money upon your death. So if you have significant excess deposits, if you're a wealthy person, each beneficiary is insured for that same $250,000. If you have a business account and a personal account at the same bank, these are separate ownership categories so that you can increase your FDIC insurance coverage by spreading it out. Keep $250,000 in your business, $250,000 in your personal, et cetera, et cetera. Fourth tip, open accounts at several banks. And this is very easy to do. You can insure your excess deposits by opening accounts at separately chartered banks to expand your FDIC coverage. Go to a local bank, a credit union, Chase, Morgan, et cetera, et cetera. If you're willing to put in the time and you're organized enough to keep tabs on all of your accounts, this is the best way to do it. Opening accounts at different branches of the same bank will not increase your insurance. You can't just simply go to different branches. Now, opening accounts at several banks is also a good way to take advantage of some of the best rates on CDs. Consider using several banks to create a CD ladder. The best rates on CDs and other deposit accounts are typically offered by the online banks. I've got one myself. It's easy to open an account there, and you can do it online and manage them through your app or through the online marketing, wherever you want. Fifth tip, consider brokerage accounts if you have more than $250,000 saved. It might be a good idea to set up a brokerage account with an institution like Fidelity Investments. Mine's with Schwab. And brokerage accounts typically offer CDs from different banks across the country, giving you a whole wide variety of options to spread out your money in a one-stop shopping type of environment. Now, be aware that you're responsible for making sure your money is spread out among separately chartered banks to maximize your FDIC insurance. Another one is credit unions. Credit unions are another spot for excess deposits that are not FDIC insured. The National Credit Union Share Insurance Fund, that's called the NCUSIF, if you're taking notes, is the federal insurer of deposits at National Credit Union Administration. Member credit unions like this, like FDIC insurance, is backed by the full faith of the credit of the US government. So the bottom line here is you need to protect yourself, and that is the point of today's video. Any individual or entity with more than $250,000 in deposits at an FDIC insured bank should see to it that all of your money is federally insured. Look out for yourself. You don't want to lose it. It's not only diligent savers and high net worth individuals who might need extra FDIC coverage. It's corporations, family foundations, governments, and charities. They all use bank networks and other measures to expand the federal insurance protection of any of their deposits. So take note of this. Use these ways to protect yourself. Get exposure to other assets. We talk about gold a lot on this channel. I'm not going to bore you with that in today's video, but keep yourself safe knowing that if your bank closes, there are ways to spread out and mitigate your risk and keep your deposits insured.